How Prague outsmarted a bank run. It began with a movement so subtle, most people never noticed it. No lines outside branches. No frantic headlines. Just money leaving quietly, deliberately, as if guided by a shared instinct no one acknowledged aloud. In Prague, that silence was a warning. To understand how the Czech banking system faced a run, without ever letting it become one, we need to return to a culture shaped by memory. This was a country that remembered sudden collapses, currency shocks, and confidence lost overnight. Stability here was not assumed. It was engineered cautiously, with an awareness that panic rarely announces itself before it spreads. That awareness still matters today, whenever trust depends on timing more than truth. The story begins with data, rather than drama. Regulators noticed abnormal transfer patterns between domestic accounts and foreign banks. Not large withdrawals, consistent ones. Corporate clients moving liquidity abroad. Households increasing cash buffers. Each action was rational. Together, they formed a signal that confidence was thinning beneath the surface. Prague's banks remained solvent. Capital ratios were solid. Liquidity buffers exceeded requirements. On paper, there was no crisis. But officials understood something critical. Bank runs do not begin when banks fail. They begin when people believe they might. Waiting for visible stress will be waiting too long. Instead of reacting publicly, authorities move invisibly. Supervisors contacted banks quietly, requesting real-time liquidity, reporting rather than periodic updates. Settlement flows were monitored hour by hour. Contingency mechanisms were prepared without announcement. The goal was not reassurance. It was readiness. Inside the banks, executives were briefed with clarity and restraint. There would be no press conferences, no emergency decrees. Normal operations would continue. But behind the scenes, buffers were repositioned, internal transfer limits adjusted, and access to central facilities ensured without triggering usage that might signal distress. The brilliance of the response lay in what did not happen. There was no dramatic intervention to frighten depositors, no denial to provoke suspicion. Instead, the system was reinforced quietly while behavior was allowed to normalize on its own. Because in Prague, the lesson was simple. The fastest way to lose trust is to announce fear. The fastest way to preserve it is to remove the conditions that would make fear rational. And as the silent movement continued, the city's financial guardians prepared for a moment they hoped would never arrive, ready to stop a run by ensuring it never needed to begin. The quiet measures began to reshape the system's posture almost immediately. Liquidity was redistributed internally, not to increase headline buffers, but to shorten response time. Banks positioned cash closer to points of potential demand. Payment corridors were stress-tested in real conditions, without ever signaling that stress existed. To depositors, nothing changed. To supervisors, everything sharpened. Behind the scenes, coordination deepened. The central bank opened discrete communication channels with major institutions, allowing instant clarification if flows accelerated. Legal teams reviewed emergency authorities without activating them. Messaging drafts were written, then set aside. The plan was not to speak first. It was to be ready if silence failed. What made Prague's approach unusual was its respect for psychology. Officials understood that reassurance, when unnecessary, can create doubt, so they avoided it. Instead of calming words, they focused on removing friction. Transfers cleared smoothly. ATMs remained stocked. Digital banking functioned without delay. Confidence was reinforced through experience rather than explanation. As days passed, the outflows slowed. Not abruptly, but naturally. Corporations completed their precautionary reallocations and stopped. Households reached their comfort thresholds. The movement that had threatened to accelerate lost momentum because the system gave it no reason to continue. There was no signal to chase. Inside regulatory circles, relief was tempered with caution. Success did not mean the risk had been imaginary. It meant timing had been decisive. Had authorities waited for visible stress, intervention would have been unavoidable and public. By acting early and invisibly, they preserved optionality, the most valuable asset in crisis management. International observers noticed nothing. Markets remained calm. Ratings unchanged. The episode left no footprint in headlines. That was the point. The absence of drama was the achievement. The system absorbed pressure without broadcasting vulnerability. For Prague's policymakers, the lesson was reaffirmed rather than learned. Bank runs are not defeated by strength alone. They are defeated by anticipation, coordination, and restraint. Knowing when not to act publicly is as important as knowing how to act decisively. The run that never happened became a quiet proof of concept. Trust was preserved not by spectacle, but by preparation. And as the system settled back into equilibrium, one truth remained clear. In finance, the most effective defenses are often the ones no one ever sees. The true test came when external noise threatened to break the silence. Reports from neighboring markets hinted at instability. Headlines elsewhere spoke of tightening liquidity and nervous depositors. In Prague, officials knew this was a moment when psychology could override fundamentals. If fear arrived from outside, it would not wait for data. Instead of escalating publicly, authorities doubled down on invisibility. Banks were encouraged to continue normal lending activity, avoiding the signal that caution was spreading. Internal stress limits were relaxed selectively, allowing flexibility without changing outward behavior. The system absorbed pressure internally rather than reflecting it outward. Inside payment systems, monitoring intensified further. Real-time dashboards tracked deviations measured in minutes rather than days. Any anomaly triggered immediate internal response. The goal was simple. No depositor would ever encounter delay, friction, or explanation. The moment someone asks why, confidence is already lost. Communication discipline proved critical. Bank executives were instructed to speak less, not more. No reassurances, no denial. Silence, when supported by function, became credibility. Every successful transaction reinforced belief more effectively than any statement could. Depositors responded to what they experienced, not what they read. Transfers completed without interruption. Access remained uninterrupted. The quiet outflow stabilized, then reversed gradually as funds returned. Confidence reassembled itself without ceremony. Behind closed doors, officials prepared for escalation that never came. Emergency facilities remained unused but ready. Legal powers stayed dormant. The success of strategy lay in restraint. Acting decisively without being seen had prevented the conditions that forced visible action. As the moment passed, policymakers recognized the significance of what had occurred. A bank run had been neutralized not through force, but through timing. The system had proven that confidence, once protected at the margins, can heal itself. The experience reshaped internal doctrine. Future defenses would prioritize early detection, rapid internal coordination, and public comm achieved through operational excellence. Crisis management would focus less on messaging and more on mechanics. Prague had not just avoided a bank run. It had demonstrated a principle that challenges conventional wisdom. In modern finance, credibility is built not by saying the right things, but by ensuring nothing goes wrong. And in that quiet victory, Europe gained a new blueprint for confronting fear without amplifying it. When the moment finally passed, there were no announcements to mark it, no victory laps, no declarations of resilience. The system simply continued, as if nothing had ever been at risk. That normality was a result, and preserving it was a point. Inside regulatory circles, the episode became a case study in restraint. Reports were written not to celebrate intervention, but to document timing. What mattered most was how early the signals had been detected and how little needed to be done publicly once preparation was in place. Success was measured by absence. Banks adjusted their internal playbooks. Monitoring systems were refined. Liquidity buffers were positioned with greater flexibility. Communication protocols emphasized operational reliability over narrative control. The experience reinforced a lesson that cannot be taught through simulation alone. Crisis prevention is an art of anticipation, not reaction. Europe took quiet note. In a financial culture accustomed to dramatic rescues, Prague's approach offered an alternative. Strength does not always need to be displayed. Sometimes it must be concealed. By refusing to dramatize stress, the system denied fear the oxygen it requires. The broader implication was clear. As digital banking accelerates movement, Runs become faster, quieter, and more psychological. The defenses of the past, lines, closures, declarations, arrive too late. Modern stability depends on speed, silence, and coordination before panic becomes visible. Prague did not defeat a bank run through force or fortune. It outmaneuvered it by understanding how confidence actually behaves. People do not flee when systems work. They flee when systems explain themselves. The run that never happened left no scar, only insight. And in a continent still shaped by financial memory, that insight may prove more valuable than any rescue. Sometimes the smallest shift in perspective becomes the beginning of a new future. How